The lecture objectives for this part of the session are: you should be able to apply capital allowances, recoupment, and scrapping allowances to a scenario. You should be able to understand release for suspensive and credit sales, and you should also be able to discuss leasing transactions. So firstly, we are going to look at capital allowances. So capital allowances in general is the taxman's depreciation. So in interest, we have depreciation, but in tax, we don't have that. And if we are going to discuss why we cannot deduct depreciation, it is simple. It has not been incurred. If you go back to our general deduction formula, you can agree with me that it doesn't meet the incurrence part because we wouldn't have incurred anything. So in this case, the taxman then sort of gave incentive. Think about it this way. We have our assets, motor vehicle, whatever. These assets are capital in nature, so we couldn't deduct anything. But we're using these assets to produce income. So because of that, over the period that we are going to be getting taxable benefits from this asset, we are also going to be allowed deductions for the, if I could say, the conduits for which led us to get these taxable profits. So what is really important to know about capital allowances for you to be able to determine properly the capital allowance of any particular asset is the cost of the asset. So you have to know the proper cost of the asset. So in certain cases whereby you've been given a scenario whereby you have to adjust the tax interest profit before tax, you need to know the difference between how the taxman and the IFRS guy treat the cost of an asset. So basically in tax, the cost of an asset includes all the costs which led it to be in a position where it can be used. So if you incurred transport costs and if there were certain modifications that needed to be done for you to be able to use that asset, then these are included as part of the cost of the asset. Then the purpose of the asset. So you find that the purpose is very important because with regards to our capital allowances that are available, it is sometimes determined by what you're going to be using the asset for, most likely than not actually. You have to know the purpose of the asset for you to be able to tell which allowance can I claim for this particular asset. And then lastly, the type of the asset. It goes without saying, we can't give the same capital allowances for a car, the same we give to a building sometimes. So the type of the asset also determines the capital allowances which it can rank for. So this is where your IS 12 comes through. It becomes very important because when you're now calculating your tax base, these are the principles that become very important. Because for you to be able to determine the tax base of an asset, you need to know what was the cost and which allowance can I get. And for you to be able to do that, you need to know these very, very important characteristics. So let's look at the types of assets that are there. So we have commercial buildings. So commercial buildings are those which are used 90% for the purposes of trade or less than 10% for residential purposes. So for example, your offices, these qualify as commercial buildings. We also have industrial buildings. Industrial buildings are those which are mainly used for manufacturing and industry research, and most likely they're like your factory, your plants. These will qualify as industrial buildings. We also have staff housing. So staff housing is mainly built for the housing of employees, but it can't exceed 25,000. So what happens if you have staff housing which exceeds 25,000? We then look at all the types of assets that we have, the types of buildings that we have. Does it qualify as a commercial building? No. Does it qualify as an industrial building? No. And does it qualify as staff housing? It would have if it didn't exceed the 25,000. So that means it falls away. It doesn't get any capital allowances. I'll explain further just now this concept. And then we also have articles, implements, machinery, and utensils. So basically these are your movables. Your furniture, your machines, your computers, they fall under articles, implements, machinery, and utensils. So you have to also go and look at the definition in the Act for this one, so you can see if there is anything which has been excluded, so that when you see it in the scenario, you are able to determine what should I be granting capital allowances or not in this case. So also quite separate and movable, which has been separately distinguished from these articles, are our passenger motor vehicles. So passenger motor vehicles are basically vehicles which have been determined, which have been designed to carry passengers. What can I call them? Your double cabs, your SUVs, those are your passenger motor vehicles. If you go into your legislation handbook, you will see all the characteristics that are there for something to be called a passenger motor vehicle. However, a passenger motor vehicle excludes taxis. So if a person is running a business of taxis, then these will be excluded from the definition of passenger motor vehicle. A hotel, Nico's Hotel has its Mercedes-Benz that it uses to carry its guests. Those also do not qualify as passenger motor vehicles. And for the purposes of capital allowances, passenger motor vehicles have a maximum limited cost of 10,000. So if you buy a passenger motor vehicle for 12,000, you only be allowed to deduct capital allowances to the extent of 10,000 and not on the 25,000. And then lastly, we have intangible assets. So mainly distinguished is the software, it's the computer software. There are capital allowances for that. And unfortunately for intangible assets, this is the main one which has been mentioned. So for the other patents and stuff like that, there hasn't been guidance on whether you can claim capital allowances or not. So with regards to these types of assets, these are not exhaustive of all. There are some which are in your module and some which are also in your legislation handbook. So if a particular asset does not meet any of these types of assets which are mentioned in the fourth schedule, then it does not get any capital allowances. This is how important it is for you to know the types of assets that are there. Then we also have the different types of allowances that you should know. So first of all, we have the special initial allowance. So special initial allowance is 25% per year, and then subsequently you will be claiming what is called the accelerated wear and tear. In the first year it is called the special initial allowance, and then subsequently it is called accelerated wear and tear. And it is not allowed to be apportioned. So if you're going to grant special initial allowance, you need to claim the full amount, even if you're going to use the asset for like 1 month in that particular year. You have to deduct the full 25%. And the SIA as well is never awarded on commercial buildings. It is never awarded on purchased buildings. It's only allowed for constructed ones. So if you construct a commercial building, you are not allowed SIA. It is also not allowed for a lessor of a finance lease. So let's say you have a building ordinarily which qualifies for special initial allowance, which you have constructed, But if you then lease it out on a finance lease, then you are not allowed SIA. So it is mainly allowed for movable assets, cost of construction and improvement of immovable assets. These are the main ones where you can claim special initial allowance. So for example, if you construct a factory building, then you will be allowed special initial allowance. Then we also have wear and tear. So wear and tear is ordinarily 5%. And only in the special case of commercial buildings is it allowed at 2.5%. It can only be apportioned for movable property. So if you're going to be claiming wear and tear on on a commercial building, for example, you're not allowed to apportion it. Only for when you claim it on a machine, for example, where you're allowed to claim it. Then on movables, it is claimed on a reducing balance method. I'm sure from our O-level financial accounting, we know what the reducing balance method is. So for example, if we claim 5% of 10,000 in year 1, that will be how much? 500. And then in the next year, we will then be claiming 5% on 9,500 and going on and on and on and on and on until it reaches 0. So mainly, this is awarded for commercial buildings, for movable assets, and acquired immovable assets. So remember, for SIA, if you didn't construct the building, you're not allowed to deduct SIA. So if you, let's say you buy a already built factory building, then you have to claim wear and tear. And then we also have what is called a scrapping allowance. It is not a usual allowance, if I could say. Scrapping allowance is whereby you dispose something as scrap. So if something is now useless to you, for example, let's say this computer that I am using, it becomes useless to CAA, and they just want to dispose it just to get rid of it, not to make a profit or anything. If they make a loss out of that, they are allowed to deduct a scrapping allowance. So note this, it has to be disposed as scrap. So if we take this computer today, in its working condition, verify it's very much quite useful to us, and then we dispose it, and then we make a loss, it doesn't mean we have scrapped. So a loss does not necessarily mean scrapping allowance. It has to be useless, it has to be now being disposed as scrap, which is no longer useful. So when you're also winding up a business, you're also allowed to deduct scrapping allowance, although it is limited to the recoupment that is available for that particular sale. So what happens then, this is where tax planning then comes through. As a taxpayer, which rate, which allowance is best for your taxpayer? Sometimes it doesn't necessarily mean that the highest is always the best, but usually it is. So you'll find that when you have the option to, it's better for you to claim SIA at 25% because you then deduct more. So when you're deciding which allowance to claim, you need to consider all factors that are there because we are trying to learn tax planning. What is best for my taxpayer? Is it special initial allowance? And if you read the Act very carefully, it says the taxpayer elects. That means it is the taxpayer which chooses. So even in real life, in practice, if you decide not to claim your allowances, they're not going to come to you and say, oh, you didn't claim your allowances, because it is the onus is on you to elect what you can claim based on the rules that are there. And then we also now look at recoupment. So let's say when you sell an asset, this is now sort of the profit, if I can say, the tax profit of selling something which is of a capital nature. So I'm sure you agree with me that the proceeds are definitely not included in gross income because they are of a capital nature. But because the taxpayer has been giving you capital allowances all along, he needs to sort of recoup that, get back what he gave to you. So with recoupments, they are included in your gross income, and they are calculated as follows. It is the proceeds. So the proceeds, it depends with the way you're sold. It could be a simple, they sold the building for 25,000. Those would be your proceeds. Less the income tax value. So what is the income tax value? This is basically our carrying amount in terms of tax. So we had a cost that we started with, and then we started claiming capital allowances. So the cost less the total capital allowances that you were claimed over the life of the asset will give you the income tax value, or otherwise also known as the tax base. It will give us a potential recoupment. So note this very carefully. This is not the recoupment, but the potential. The actual recoupment will be limited to the capital allowances granted. Remember, this is the recoupment. The taxman is getting back what he has given you. That means that you can't get more than what he can't get more than what was paid. I don't know if that makes sense. So then it is then limited to the capital allowances that you would obtain. Now we're going to look at leases. So you'll find that leases have their own special rules that apply to them, although they are just in the midst of Section 8 and Section 15 for the lessee and the lessor. So you need to know how to treat leases in different circumstances. So first of all, we have the normal lease payments. These are your normal rentals every month, the ones that you pay. So as long as these lease payments are for the purposes of trade, you can deduct. And if you are in the business of leasing, putting a tenant in a property that you have, or giving out a car for lease purposes, you include that in your gross income. And then if we look in particular, let's look at PMVs. So for the lessee, remember we said there is a prohibited deduction to a maximum of 10,000. So the lessee is allowed to deduct lease payments for PMVs to a maximum of 10,000 for every year of assessment. And then the lessor is governed by the fourth schedule. So if you remember when we just did that, there are certain people who are exempt from these cost restrictions of 10,000. So for a person within the business of leasing PMVs, they are allowed to claim capital allowances on the full amount of the PMV. If they got it for 50,000, they can claim SIA on the 50,000. They are not restricted to the 10,000, like when CAA buys a motor vehicle, which it is going to be using on a day-to-day basis. They are only allowed to deduct the capital allowances on a cost of 10,000, regardless of how much they bought the car for. And then if we look at the lease premiums, so lease premiums are basically the non-refundable deposits that you pay for you to enter into a building or into a lease. So for the lessee, you are allowed to deduct the lease premium over 10 years or the lease term, whichever is shorter. So if your lease term is 15 years, you deduct over 10 years. But if your lease term is 8 years, you deduct over 8 years. And then on the lessor side, they are supposed to include any lease premiums in full at the time that they are received. So if you receive a lease premium of 100,000 for a very prestigious building, then this should be included in your gross income in full, and it will be taxable in that year. And then we also have what are called lease improvements. So you'll find that in certain cases, lessees and lessors enter into agreements whereby they will say, you can rent my property, but As per the agreement, you have then to put pavers so it looks nice. You have to maybe change the roof, put new tiles or something like that. So what then happens is the taxman needs to tax these arrangements. So for these improvements, from the lessee side, we have two things that can arise. We have what are called obligatory improvements and those that are called non-obligatory improvements. So for the obligatory ones, these are the ones which will be included in the lease agreement, whereby we agree, you're entering into this building, you have to replace the tiles and the ceiling for 10,000. So these are the obligatory improvements, and they can be deducted by the lessee over a period of 10 years or the lease period, whichever is less. So the example that I just gave, if it's 15 years, the lease term remaining, that is, you deduct over 10 years. If it is 8 years, then you deduct over 8 years. Then we have what are called non-obligatory. So even if we agree that I'm going to do them for 10,000 the ceiling on the floor, and then I end up incurring 15,000. And only the 10,000 is the obligatory one. The other 5,000 is considered voluntary. Or even out of the blue, a person can decide that, I don't know, this is my place of business, I just want to put a loan or something like that. Or put an electric gate, an electric fence, a new drawer. Those are called voluntary improvements, and the lessee is allowed to deduct SIA or wear and tear on these improvements. It is the lessee who decides which of the capital allowances they want to deduct. And then for the lessor, they should include it in their taxable income proportionally for 10 years or the lease period, whichever is lesser. Then lastly, we're going to look at suspensive sales and credit sales. So from our gross income definition, you agree with me that the moment someone, because if I could explain first the suspensive and credit sales. This is, for example, where you go to TV sales and you buy your TV and then you pay over a period of like 12 months or something like that. So you agree with me that the moment we deliver the goods, the gross income would have accrued. And the taxman will need us, the law requires us to include the full amount into gross income because it has actually accrued to us. We have done our part, so the part is now for this other party to pay the money. However, because we wouldn't have received the money, the taxman then offered some sort of relief to these guys. So you're being taxed, if you understand, you're being taxed on sort of money that you haven't actually received. So you get a relief. It is not a deduction, it is just a relief. It is temporary until you get all your money. So the relief is basically based on the profit. Note the profit, not the full amount, but just the profit that you haven't actually received. So if you go in your module, you will see the formula on how you can calculate the profit which has not yet been received, which you can be allowed relief on. And then in the subsequent year, you can then include this relief back into your taxable income and then calculate the new one based on the profit that you also haven't received. Because after a year, you have received some of it, so now you have to recalculate how much is still outstanding. So this is basically it for credit sales and for taxation of corporates. Please go into your module, do the questions in revision on this taxation of corporates. It's quite a highly examinable area. And do the practice questions, follow your study plans, and you will be guaranteed to succeed. Thank you.